Gold continuing its record-breaking rally. Bank of America suggesting the precious metal could reach 3,500, driven by central bank buying and haven demand amid rising geopolitical and macro uncertainties. Francisco Blanch of Bank of America joins us now for more. Francisco, welcome to the show. A 19% move in the first quarter, the biggest quarterly gain going back to 1986. Francisco, let's talk about the drivers of the first 3 months of this year before we get into the next 9 months of 2025. What got us to this place?
Thank you for having me again, John. So I think gold has been really drifted up by essentially, we started out with central bank buying in the last 3 years, but I think investors have started to accumulate as well. So I think what's really changed has been more investor buying, whether it's through ETFs or other instruments, but also we are seeing asset managers and insurers starting to pile in. So that's been the change. Remember, we've seen a weakening U.S. dollar. We've also seen falling interest rates, at least on 10-year yields in the U.S. And that's kind of led to incremental demand for gold. Plus, of course, there's the issue of tariffs and the potential implications that may have in the economy. So I think all of that has come together. But gold's not alone. I mean, we've seen a big rally across the commodity complex. We've seen also coffee moving up. We've seen silver. Actually, commodities are up almost 9% in the first quarter, John. I mean, it's been a really strong run, maybe a little bit of an unexpected run. And the sector has outpaced bonds and equities across the board.
Francisco, before we dive into just generally the commodity rally, how distinct is gold given its hedge factor as well as increasing concerns, as we were speaking with George Saravelos earlier, about diversifying away from the U.S. dollar?
Well, so I think there is an element here of diversification, no doubt. I mean, central banks are now holding about 10% of their reserve assets in gold, and that number is likely to continue to increase at an annual pace of 1% to 2%, probably as far as the eye can see. Remember, one of the things that the Trump administration is trying to do is to rebalance the U.S. twin deficits. And that rebalancing of the twin deficits, by definition, implies that there is a lower desire by the Trump administration to continue to supply this reserve asset that the world has been craving for a long time, which is U.S. Treasuries, right? So if you reduce the deficit, if you reduce the budget deficit, if you reduce the current account deficit and the trade deficits, by definition, there's going to be less treasuries available for central banks around to hold. And then there's the whole sanctions and tariffs overlay here that's also driving the demand for gold.
So I guess that my question for you is, have we seen the bulk of it? Why isn't your target higher? You say 3,500 as your recent target. We were just talking to Ed Yardeni, who left the office saying 4,000 by the end of this year and 5,000 by the end of this year. And it seems like people can't get enough.
Well, I mean, there's a little bit of that right now, but also remember, gold is a pretty large market already, right? It's over $10 trillion in value. So of course you can put any number there because there's no such thing as intrinsic value in something like gold. I mean, there is of course a cost of production, but as we know, mining increases the stock of gold by 1.5% a year. But the real story here is how much investment can you drive in? Of course, gold could spike a little higher, but you would need to see a much worse economic outcome than what the market is currently pricing in our view, right? So it's going to be a steady grind higher as opposed to a big jump, unless something dramatic happens.